Hello and welcome to the lecture for Chapter 3 concerning professional ethics for auditors. In this lecture, I'm going to talk about the nature of ethics in general, a subject which is often not as clear-cut as it might appear in textbooks. I'll talk about the reasons for establishing a code of professional ethics. I'll talk about the principles, the rules for the AICPA's pronouncements on ethics. I'll talk about independence and how that is measured, and here we'll get into an area where it is very specific and discrete, so easy to determine. I'll talk about the differences between the AICPA's approach to ethics and the PCAOB. So again, those are the bodies that deal with, in the first case, non-public audits, so private companies, and in the second case, the PCAOB audits of publicly traded companies. And I'm not going to cover internal auditor ethics, so that is something you can read about in the text if you're interested. So in general, ethics is a branch of philosophy that studies reflective choice. So how do you determine what is right and wrong, which path to take when it isn't very clear? So that involves decision problems, so questions that force you to decide between potentially helping one party and harming another party. And it deals with moral principles. That's what do you personally believe to be right and wrong, just and unjust, and then determining the consequences of those decisions. So who benefits and who is harmed from the outcome. So an ethical problem situation is one in which you have a choice of alternative actions that affect other people. So an example of that might be you have to make an entry in December reallocating debt from long-term debt to current debt because it falls within a 12-month window at that point. And knowing that when you make that entry, you'll violate bank covenants, which will cause you to lose your bank loan and cause the business to close. So do you forget, I'm making quote marks in the air here, do you forget to make that entry so that you have a year-end statement that satisfies the bank, or do you do the right thing? So that's an example of an ethical problem. So there's a code of ethics that guides our profession so that we don't need to struggle with those kinds of decisions. We can apply the code of ethics to it and determine what to do there. So a code of ethics requires a public declaration of principled conduct, which is what the accounting profession does. This is how we behave. This is how we deal with questions like that. And then some means of facilitating the enforcement of that. So what happens if you violate the code? So having a code of conduct with no consequences for violating it, of course, is kind of meaningless. So the means of facilitating enforcement in our profession is you lose your CPA license, which is very consequential. So a basic structure for an ethical decision is, first of all, to define all of the facts, okay, and identify who it is that needs to make the decision. In this case, it might not be the auditor. It could be the controller at the company or the CFO or the owner of the company, not you. So what are all the facts in the situation, and who is it that's responsible for deciding the action? Next, identify all the stakeholders that are impacted by the decision. So that might be the bank, it might be other lenders, it might be shareholders, it might be employees. So who is impacted by the outcome of a particular decision? Next, identify the rights and responsibilities of each of those people, both in general and to each other. Next, identify what the alternative actions could be. So I can do A, B, C, or D, and these are the consequences of each of those, and then choose among those alternatives. So kind of a structured process to it. So when is a code of professional ethics required? Well, one requirement is when there is a responsibility to serve the public. I mentioned in a couple lectures ago that sometimes accounting is referred to as the one true profession, although I've only heard accountants say that. But what they're talking about is that of the professions, say medicine, law, and finance, There is a responsibility in medicine to cure your patient. There's a responsibility in law to represent your client. The responsibility in accounting is to the public at large. It's not to the existing shareholders, it's potentially to future shareholders, or future lenders. So we're responsible to a group of unidentified people in addition to people that we know are stakeholders. Another is it requires a complex body of knowledge. I don't have to tell all of you, you've been through a lot of classes learning about accounting. 5 years of college and plus practical work experience is required in order to get a license. There needs to be some standard of admission to the profession. In the case of our profession, it's getting your CPA license, meaning having the education, passing the test, and having the work experience. And then the requirement or the need for public confidence in the profession. And I would assert that any CPA or any CPA firm, their primary asset and their product is their credibility. So if people don't trust and believe them, they literally have nothing. So the AICPA, so our professional organization that oversees CPAs, has a code of professional conduct that is built similar to the way the generally accepted accounting standards are built, which we talked about in the last chapter. So there are principles that give us the overall framework, there are rules, and then there are interpretation of those rules to specific circumstances. So the structure of it is important to keep in mind that it covers members in public practice. That's what the focus of this class is, so auditors. And that it also covers members in business. So there are sections of it that also apply to controllers, to CFOs, to staff accountants, those kinds of people. So some of the principles here. One, responsibilities. So that is, you're responsible to act as a professional at all times. So remember that when you interact with the public, you're representing the profession. Exercising sensitive judgment, all of those things are critical. The public interest, first and foremost, your responsibility is to the investing or lending public, providing accurate information. Next is integrity. Of course, integrity is necessary for public confidence. So somebody needs to know that you're exercising your responsibility, and integrity means doing the right thing. So it's kind of honesty in action, if you will. Objectivity and independence, we'll talk more about that in a minute, but in order for the public to have confidence, they need to know that you can make decisions regardless of what your relationship is with the client, so that you're going to do things appropriately and be black and white about it. Next is due care, that you should make sure that you meet the ethical and technical standards in order to do the work you take on, so that you're competent to do that work. That's important. And then scope and nature of services, meaning you're not going to take on services that are not within the proper scope of what an auditor would do. Not take on jobs that you're not qualified to do. So a little bit about independence, and I talked about this earlier. There are two aspects of independence, and the rule applies to both. One is independence of mind. So I mentioned that example about current and long-term debt and violating bank covenants before. If you were an auditor and you were auditing your best friend's company, a friend that you've had since you were a child, and you came upon that entry not having been made, would you be able to force that entry to be made or leave the audit, or give an adverse audit opinion? If you have some question in your mind about whether or not you could really do that to your friend, then you're not independent, and you shouldn't do that audit. You should suggest that somebody else that is more independent do the audit. Independence in appearance deals with how other people perceive your relationship with the client. So you may be independent in your mind. You may be perfectly willing to give your best friend an adverse audit opinion and tank their business, but what do other people see about that relationship? Do you vacation together? Do you own a boat together? All of those kinds of things would cause somebody to doubt that you are really independent, which would undermine the credibility of the opinion that you issue. So now for some specific rules. And there are two levels of rules that deal with independence. There's one level of rules that concern all the staff within the firm firm-wide. So a big accounting firm can have offices all over the world. We're talking about all of the partners and professional employees. So not the receptionist or the janitor, but any staff accountant or staff auditor, anybody doing tax work, seniors on jobs, managers, partners. So all the professional employees of the firm, the rules are as follow. They cannot own more than 5% of a client during the period of the engagement. So if I work for Moss Adams and I'm doing an audit of a local car dealership, as an example, nobody in Moss Adams in any of their offices can have an ownership interest in that car dealership that's more than 5% of that business. That would preclude them from being able to do the audit, the whole firm. It also applies to investment groups. So sometimes people throw their money in together and form a club and make investments in that investment club. They can't also have a 5% interest that way. And then no partner or professional employee can serve as a director, an officer, or an employee of one of the companies that you're engaged with to audit. So now we narrow the scope a little bit and just talk about covered members. And there's a higher level of requirements for independence for covered members. So first I'll define what covered members are. They're an individual on the audit team. So there's somebody, a staff auditor or a senior or a manager or a partner that is involved on that particular audit. Anybody in the firm that's in a position to influence how that audit is being done. So it could be other partners, that sort of thing. So any other partner in the office that is doing the audit, it would be covered, would be a covered member. And then certain partners or managers who provide non-attest services to the client. So maybe the tax senior that is doing tax returns for the company. They would also be a covered member. So those particular rules state that covered members cannot have any direct financial interest at any level. So the 5% rule goes to 0. You cannot own any direct financial interest, meaning owning stock in any of those companies. You can't have any material indirect financial interest. And an indirect financial interest would be, as an example, your 401k is invested in a mutual fund and that mutual fund is invested in a client. So that's okay if your 401k is say 25% of your assets and that mutual fund is 10% of your 401k and the investment in the client is 5% of the mutual fund's holdings. That would be very, very small and insignificant. So it would not be material to the covered member's net worth. That's what it's relative to. So you can't have any material indirect financial interest. Your immediate family members are treated the same as covered members. So it's not just the covered member, it's their spouse and their dependents. Those are considered immediate family members. Then you enlarge that circle, and any close relatives can't be in a key position or hold a material investment in the client, again, relative to that close relative's net worth. Close relatives are defined as parents, siblings, or non-dependent children. So firms that perform audits need to collect this information from all of their auditors, all of anybody that would be considered a covered member. You would also need to collect that information from your immediate family members and your close relatives. That information would need to be submitted to the firm so they can make a judgment about whether or not you would be considered independent and could participate in a particular engagement. So it's a fairly high bar to pass, which is a good thing. So some identified threats to independence that you should be aware of. One is familiarity. That's kind of the best friend scenario I gave you a little while ago. So if you have too close a relationship, that may be a threat to your independence. Adverse interest threat is when you have a conflict with a client. Maybe you have sued them over non-payment of fees in the previous year and now you're doing their next audit. That's an adverse interest. Undue influence threat means the client has something over you. They say either give us a clean audit opinion or I'm going to tell your wife you're cheating on her, that kind of thing. Self-review threat, we'll talk more about this in a minute and give some examples of that. That basically boils down to you can't audit your own work. So if the client engages in you to, as an example, build their depreciation schedule and tell them what the depreciation entry should be, you then can't audit the work on accumulated depreciation because you've had a hand in creating it and you can't independently look at your own work. Financial self-interest threat, that means that the result of the audit can't benefit you personally. You can't get a bigger fee if the audit opinion is clean or get access to other business opportunities based on what you complete your audit as. Management participation threat, it's often a very common thing for management of a company to ask their auditors for advice during the course of the year. The auditors are professionals that have respect. They know the company inside and out from having done the audit, so it's natural for management to lean on their auditors to say, what do you think about this or that? Should we expand into this new market or launch this new product? Would you take a look at this? That's something that auditors can't do. It essentially leads to self-review. And then advocacy threat. You can't promote your client. You can't give a testimonial for why people should invest in your client. So now the SEC and PCAOB rules on independence are a little bit more stringent. So in addition to having independence in fact and appearance, the rules we just talked about, they also prohibit you from engaging in other services with your audit clients. You can't do bookkeeping services with them, of course, or for them. That would essentially lead to self-review. You can't design their information system, meaning install their accounting software and tailor it for their needs. That also would lead to self-review. You can't engage in appraisal or valuation services if they're going to sell or buy assets. You can't engage in actuarial services, which pertain to their pension funds and what is due in the future. You can't engage in internal audit services, so you can't also be hired by your audit client to do internal audit work. You can't, of course, participate in management functions, which we talked about earlier. Human resources really deal with recruiting. So you can't recruit accounting personnel for the firm because then that person is beholden to you for their job and it sets up an improper relationship. Broker-dealer services deal with buying and selling parts of the company. So if they want to divest of a particular product line or division or subsidiary, or they want to acquire another subsidiary, you can't assist in that effort. You can't perform legal services for your client or expert services. Expert services would primarily be testifying in litigation on behalf of the client. Of course, you can testify if you're subpoenaed and called upon to testify, but you can't be hired by your client to be an expert witness in a trial. You can't in any way have contingent fees or commissions. So contingent fees are if I complete the audit in a shorter amount of time, I get paid more money, or if the audit is clean, I get paid more money, those kinds of things. Your fee is your fee, period. Commissions would be more like referral. So if I refer you to somebody else to do something, I can't get a fee from that company for the referral. And then you can't perform tax services for key employees. So you can't do the annual tax return for the CEO, as an example. So more rules for, again, these are for publicly traded companies. Audit fees must be disclosed by the company to the shareholders. So it needs to be very clear, and audit fees for big companies can be very, very large. So that needs to be explained to the shareholders. Who determines if you're independent ultimately is a responsibility for the audit committee. So that's a subgroup within the board of directors, and they're the ones that would make a judgment about whether the audit firm is independent. Now, the audit firm also needs to make a judgment if they're independent because it affects their liability. They could expose themselves to financial risk if they're later shown to not be independent when they've issued an opinion. Engagement partners need to change every 5 years. That's to protect against overfamiliarity. And then you can't perform an audit in a year when one of your audit employees, so an employee of the auditing firm, moves to the client. So example, the senior on a particular job or the manager on a particular job moves and becomes a controller of a client. You can't then audit that client that next year. Somebody else needs to do it. So integrity and objectivity, so I'll just read this here. In the performance of any professional service, a member must maintain objectivity and integrity, shall be free of conflicts of interest, and not knowingly misrepresent facts or subordinate his or her judgment to others. So being objective is linked to being independent. Integrity is acting with honesty. Free of conflicts of interest mean that I can't be worried about how an audit and one client affects another client or my firm. I can't knowingly allow there to be errors on financial statements that are material, and I can't kind of subcontract my decision making out to somebody else. Those things apply to both auditors and private CPAs. So anybody that calls himself a CPA needs to comply with that. So in addition, a member shall comply with the following standards. So they need to have professional competence, meaning continuing education. They need to do their job with due professional care. So they need to not be hasty or sloppy in the way they do their work. All work needs to be properly planned and supervised, and they need to gather sufficient relevant data in order to express an opinion. So there are different committees and boards that regulate standards. So we're saying that anybody that is a member and performs a whole variety of different kinds of accounting services has to comply with the standards that these committees issue. So a member shall not express an opinion or state affirmatively financial statements are in compliance with GAAP if they are not, if they contain a material departure from the standards. This raises an issue because there are some non-GAAP reporting that are done by companies, providing additional information to clients, and so how to deal with those is kind of one topic of interest to auditors now. So confidential information, so the information between you and your client is confidential but not privileged. So if a court requires you to disclose it, you have to. You are allowed to blow the whistle if you feel that somebody is doing something inappropriate in a company, but you're not obligated to report illegal acts. So if you find that a client is not paying overtime in violation of the Fair Labor Act, then your responsibility is to withdraw from the engagement. You can blow the whistle, you can report them if you choose to, but you're not held liable if you don't do that. So it's a little bit different than, say, privileged information. A lawyer can't disclose what you've told them if you're the client. It's not the same with accountants. It is confidential in the sense that you can't gossip about what you learn on an audit with other people. So a little bit about commissions and referral fees. So contingent fees are not allowed for either audit or tax. You can't commit acts discreditable to the profession. So engaging in inappropriate behavior that brings discredit on the accounting profession is not allowed. You shouldn't seek to obtain clients by deceptive advertising. And then referral fees. You're not allowed commissions with the exception of non-attestation clients, and referral fees are allowed but must be disclosed. And then any member may practice public accounting only in a form permitted by law or regulation. So you can be a partnership, you can be a limited liability corporation, you can take those legal forms, and that's acceptable. So that's the end of the lecture. It went a little bit longer than I anticipated, but there is just one lecture for this chapter. So thank you, and I look forward to talking to you in chapter 4.